So over the course of our client conversations over the last couple of weeks, there was one key question that we saw come up over and over again, and that is the question that says, obviously we've seen a lot happen here. Markets are holding up really, really well. Why? And I think that's a really great question, because even as we're sitting here videoing today on Tuesday, April 14th, I will tell you that portfolios are up year to date. Like, we have no model that's down. They're all positive and starting to make some actually reasonable headway for the year. Now, I think one of the key things that makes this surprising to a lot of folks is that when I observe a lot of financial media or a lot of observation about the market or what's being written, there's an embedded assumption in a lot of reporting. And that embedded assumption is that oil price spikes cause market and economic crashes. And I'm just going to say is that may happen in this instance. However, if we take a look back at financial history, see that so far this just hasn't been true. If we take a look at the graphic that we're going to put up here, there's been 224 recorded instances of an oil price spike that we can bring up in modern history. And we can see very clearly that even in the short term, but especially in the intermediate term, markets respond positively. And that means that assumption about oil price spikes equals market crash is a faulty one. Now, there's a number of other reasons why markets can also be up, and be positive despite all of the negative headlines that we've been seeing. Now, the first one I think that's the most important is that earnings estimates have gone up since the Iran war began. Now, this is very significant because if you have a jump in earnings expectations, that makes the market cheaper. And then if you have the market pull back a little bit, it becomes even cheaper. So we've got a situation where we've had, with a very minor correction, a full valuation reset. Now, a full valuation reset. If we were in a world where earnings estimates hadn't gone up, yes, it is very likely the stock market would have gone down 20% to get that same reset. So the fact that it occurred on such a mild pullback because of earnings going up is is one of the reasons things have held up. Now, why would that earnings reset be there? And I think that that earnings growth estimate is really tied to the fact is that we see continued economic growth and continued acceleration in real-world economic measures. Now, we can see from key survey data that looks at the industrial economy in the U.S., which has been in a tough spot really for the last 30 months. It's very clear now that there's a positive trend in the industrial economy in the U.S. And if we look at real-world measures of economic activity, such as truck traffic and rail loadings, we can see that they are going up very, very steadily. So all those are very positive, and definitely you do not see truck traffic going up or rail loadings increasing in a recession. It only happens in an expansion. So we can be pretty confident that the world's largest economy, the engine of the world economy, continues to grow. The next thing we always want to remember here is that the stock market is also partly an expectations game. And that when investors get too negative on the outlook, that generally leads to a very positive response. And when investors get too positive on the outlook, it leads to a negative response. Again, we always want to be living in alignment with Warren Buffett's saying that you want to be greedy when others are fearful and fearful when others are greedy. And we can definitely see, through this data, courtesy of Ned Davis here, that investors are fearful. And they've gotten so unusually fearful, in fact, that forward returns look really, really good. In fact, based on this Ned Davis data, we should expect returns of over 20% in the next 12 months. Now, I'm not saying that's going to be true. That's not a prediction. But again, the historical pattern is clear. Investors' fear is high. Future returns are also high. And this also brings me to another important tailwind for why markets have held up. We're in a situation overall where markets have typically done very, very well. If we take a look, and this is where I always love to draw on quantitative studies that look at history. And if we look at key quantitative studies and indicators such as the turn of year barometer or the January barometer, they both point in the same direction. And they both say that 2026 should be a positive year about 90% of the time, and the market should be up in the mid-teens to the low 20s. Now, that's certainly not a guarantee, and it's certainly not a prediction on my part, but what it's saying is that based on these indicators and other ones that also back them up, that the preconditions are there for that type of a result. So if it happens, we shouldn't be surprised. We should be surprised if it doesn't happen, and we always want to be aware that it could, but we shouldn't be surprised that if you have a positive setup, that positive things happen. So hopefully that provides some clarity on this point. And if you do want to get into this in more detail, or talk a bit more about it, please reach out, book a time on Calendly, email us, be in touch any way you want, and we're happy to have that conversation.